let's talk about that macro picture and the interplay with the market. Stocks higher today despite those disappointing headline numbers in the October jobs report. For more on the latest data, what it all means moving forward, we want to welcome in Dana Peterson, Conference Board Chief Economist, and Michael Antonelli, Baird Managing Director and Market Strategist. Fantastic to see both of you. Dana, I want to start with you. I mean, everywhere, everything from noisy to muddy was how I saw the jobs numbers today described. Do you think, as Josh was saying, that folks are sort of looking past it or trying to just, do you think people are sort of discounting today's numbers?
I think you should. We did have a lot of volatility there in terms of hurricane effects and also the strikes. And then we also saw a pretty big decline in temporary help workers, but that's been negative. We've been seeing negative prints for that indicator for almost 3 years now. So I think if you add back in the roughly 40 to 50,000 strikers, also you erase the effects of folks who were impacted by the hurricane, which was more apparent definitely in the household data relative to the payrolls data. I think you can say that this report might not have been as bad, and that we should definitely look through it. One concerning thing is that we did see some downward revisions to prior months, but even still, when you added up payroll gains over the prior months, they were still very healthy.
Michael, let's get you in here as well. Now, we've heard from the economist on the panel. Want your take as well as the market strategist. What did you make of that jobs report?
I think Dana's right. It's certainly noisy. That tends to happen, by the way. We're talking about a statistical guess at a labor force of 180 million people. I love how we're always looking for certainty in that, even though it's basically impossible to happen. I think we need to look at some of the revisions, as was mentioned, certainly negative. But you know what? If you think about it, the labor force, it's probably stagnating. The labor force is probably slowing. I don't think it's catastrophically slowing. Temporary help softening, long-term unemployed rising, quits are softening. So yeah, if you were to look at the last 3-month average, you're certainly looking at a private payrolls that are probably stagnant. And I think that's on the Fed's mind. I think it's on the market's mind. But I would like to remind everybody watching that the market is not reacting to data from October of 2024. The market is looking out into spring of 2025. Let's remember that the U.S. stock market is a leading indicator. Employment is a lagging indicator. So I think more importantly is what is the stock market and the bond market saying about next year? Because those are the things that it's really thinking about.